Scott, I like the market long term. I mean, actually, it's 18 times earnings. S&P is 18 times this year's earnings or forward 12 months earnings. That's very cheap. X-Tech, it's 15 to 16 in a low interest rate environment, even with the Fed hiking. That looks good. But I think the Fed next Wednesday is going to sound hawkish. I think Powell's going to be hawkish. So I think the market's going to have to digest that. I think there might have to be a little more capitulation. I mean, I would love actually the VIX to get above 40 for a day or two to really flush out all the margin and all the overvaluation, which I think has mainly been flushed out over the last 9 months, 6 months particularly. So I think we're very near a bottom, maybe not quite there. It's very hard to predict the short run.
Well, very near a bottom, but not quite there. You know, it's interesting when you say that Fed's going to be hawkish and the market's going to, these are my words, not yours, are going to have to come to grips with that. I thought the market already knew it was coming, Professor. So what are we still trying to come to grips with?
Well, the market knows it's going to be hawkish. Most of the journalists who are going to ask questions are going to say, hey, we had negative GDP. Aren't you worried about a recession? And I think Powell's going to be pretty tough on that, rather than saying, yeah, we're going to have to look at it and we may have to moderate our increases. He's been so behind the curve. You know, what you have is a pendulum. They've been so behind. The worry is, are they going to stay too tight, saying, you know, listen, you know, we're not going to get that criticism anymore. So I think he's got to show a firm face, even though he himself is saying, you know, our medicine may be beginning to work. By the way, Scott, let me say, you know, I look at the money supply. We had that report last on Tuesday, and 2 months in a row, we've had a meaningful slowdown in the growth of that money supply, and that's an absolute prerequisite for slowing inflation. Now, with all that said, you know, we have 25% more money in the system, even after trend corrected, than we did before the pandemic. And we've only had 7% more inflation. So I think there's still a lot of pent up inflation that's going to be reported in those statistics. And, you know, the Fed is going to be very, very sensitive for having started so late. So they're going to have to put on a very tough face on this. But I was encouraged by the first time since the pandemic that we were actually looking like we're controlling the supply of credit. We need many, many more months of that moderate monetary growth to really slow down this inflation. And honestly, I don't think it's going to happen for another 6 to 12 months. We're going to be maybe a little lower than now, but we're running 5 and 6% inflation for quite a while.
Professor, you know, you use the word capitulation, and that's the word that matters, you know, for the narrative of where we may go before we feel a little bit better. And let's be honest with ourselves too. There are a lot of people watching now. There's a new cohort that's come into the market since the pandemic started. You know, maybe some of them are still with us. They've never felt that before. They don't know what capitulation feels like, and they're listening to you and Adam and myself, and they're saying, what are you guys talking about? Like last Friday, market was down 900 on the lows, and now here we are down more than 900, and we closed basically on the lows. When do you know? You say we're getting close to a bottom. When are you going to know that we're there?
Oh, I mean, one would have to be a true psychic and seer to know the absolute bottom. But
you know
Scott,
what I mean.
Remember,
I don't need you to pick the number. I don't need you to pick the number. But like, what is going to be the most telling sign? We've already had 90% down days or thereabouts in terms of volume. So all of the telltale signs may suggest that we've reached that point, but then we get smacked upside the head like we are this Friday, like we did last.
Right. But also remember, it was 2 years ago in March. So, you know, if you've been in the market more than 2 years, you know, the market was down 35% from February to the end of March in 2020. So, you know, you experienced the bear market. I think the VIX went up to 80. I mean, I'm not saying it's going to go that high, but that's That's the type of thing that you get in capitulation. Nor do I say the market's going to go down 35%. I don't even think S&P is going to get in bear market range. What is it, down 13 now? Approximately from the high. That's still correction territory. NASDAQ, I know, is in a bear market. I said that last year that I thought NASDAQ was going into a bear market. I thought S&P might barely get there, maybe another 4 or 5%. It is so hard to actually pinpoint that low. If you're a trader, these are the things you worry about. If you're a long-term investor, I think these are values you become interested in the market at.
Yeah, I agree with what he said at the end there. That's what I'm kind of pushing, a longer-term investment view. I think you'll know when the bottom was 6 months after the fact. I mean, there's no way you can forecast that perfectly. So I think you're just trying to, get some combination of valuation, sentiment, fundamentals. And I think the judgment is the risk reward's looking. I told you today, I'm starting to think about these things a little bit more aggressively. We look at the GAAP earnings, so maybe we think it's a little bit more expensive than the number you throw out at 18, but it's roughly in that same vicinity of slight premium to the long-term history, but starting to look pretty attractive. So I don't really know if the only thing I think I would disagree with a little bit is I don't know if the Fed is behind or not. And what I mean by that, and I'd like to talk about this a little bit, is what I don't think them raising rates will handle or really address why we have supply-demand imbalances.
Well, obviously
in wheat or semi.
They can't deal with the supply, but they can hit demand. That's what they need to do.
They can, but do you want to hit demand on wheat to the point we get equilibrium? Because that feels, like the economy will down 25%. So my point, I'm being a little bit sarcastic. I'm just saying a little bit I'm not, obviously he's got the credibility to criticize anybody he wants, Dr. Siegel does. But for me, I just tend to think the Fed are generally pretty smart. And they've been kind of saying maybe we shouldn't raise rates a lot because we're not going to handle some of the things that cause supply-demand imbalances.
Professor, I keep hearing this view, and it's not just from Adam, that, the Fed's going to, turn a little bit dovish. Right? They're not going to put us in a recession.
Fed fund futures kind of show that. I just would point out they ripped massively last fall through a couple months ago, but you're not seeing the perception about rates accelerate anymore. So when I say I think we're near peak hawkishness, I'm just talking about the Fed fund futures. But respond. I mean, tell me why I'm an idiot again. I mean, it's possible.
No, but the Fed was really behind the curve. I mean, they should have started tightening last year, and now they're getting a lot of criticism, and I think justifiably so, by not looking at all the credit that was created. They dismissed that model. I have been harping about that model for over a year. They totally dismissed the money and credit that was created, and they went on their merry way and just let the thing get worse than it should have gotten. It doesn't mean they won't get it under control. And that they will eventually. But they're putting us through a lot of inflation, and they may put us through a mild recession, maybe in 23. I'm not ruling it out to get out of this situation, but I do blame them for starting way too late in this game. As much as I respect the people that are on there, I think they were not looking at all the data in their decisions.
I think to a person, the Fed chair, if he were sitting here, wouldn't be able to really argue with you, Professor. They know that they were behind the curve, extraordinarily late. I'm sure he's embarrassed and feels bad by it, but also in the same respects knows that they have a job to do to make up for whatever deficiency they had in the way that they saw the inflation picture. And they sure as heck sound like they're darn ready to do it. And that's the key point. They're ready to do what they have to do to get what they think needs to be done to get inflation under control. And if the stock market goes down as a result of that, so be it. So be it. Professor, I can't thank you enough for your time this Friday. We'll talk to you again soon.
Thank you very much. Thank you.
All right. That's Jeremy Siegel, the professor, of course, at the Wharton School. Thank you so much for being here, too, AP.
Have a good weekend,
It's good
guys.
to have you right on set here so we can kick this around. An important day. All right. That's Adam Parker. Speaking of